Gold is up 6% since the Fed raised rates last month, but can this rally continue despite net outflows we're seeing in gold ETFs? Joining me today is Vince Lanci, founder of Echobay Partners. Vince, Happy New Year. Welcome back.
Happy New Year, and thanks for having me.
So tell us the real deal here, Vince. What's your take on this gold moving higher despite outflows we're seeing in the ETFs here?
Well, if you speak with the FinTwits group, the ideologues that want to focus on ETFs, GLD has dropped about, I don't know, 10 billion over the last 3 to 5 weeks. But there have been buyers of gold in futures. So what you're seeing is small retail get out, and you're seeing larger funds get in at this time. The outflows are a function of people that need to sell gold, specifically Americans that need to sell gold to buy iPhones and pay their expenses.
Let's talk about your call before the new year, Vince, about selling Bitcoin and buying gold. Given gold's nice run here and Bitcoin's a retracement, kudos to you. You were also saying 1,700 was your gold target. So are you adjusting that now, given the recent price action we're seeing?
Well, my target is actually higher than 1,700, but I would be happy with 1,700. And the reason that 1,700 is a number, it's just a number. Gold is not determined by financials, by supply. It's determined by emotion, and that means that you have to look at how it's managed by people who don't want the price higher, and how it's let loose by people who don't care that much. So to answer your question directly, I think we have another $100 of upside here for this run, depending on your time frame over the next 3 to 6 months. 1,700 hasn't changed at all for me as a target. I'd be happy with that. I expect higher over the next 12 to 18 months. But for the next 3 to 5 days, I'd be happy with a sideways chop. A $15 sell-off wouldn't bother me in the least.
Vince, many would argue that given the context and scenario gold's operating in right now, higher interest rates, a rallying stock market, that gold should actually be much lower, below 1,200, some have suggested to me. Do you agree with that? And if so, what's keeping the metal afloat?
Well, I mean, the argument for interest rates being higher as making bonds, say, be a competing asset for gold, which yields nothing, so to speak, is something that's rolled out every time bonds sell off. And you're going to start seeing the mainstream media start discussing that now. And so when they say bond yields are high enough and gold yields nothing, it's time to buy bonds, possibly, and that will detract from gold. Yeah, that would be a reason that gold could sell off. But it's specious at best. It's an erroneous statement because interest rates are going higher, but real interest rates are still low. And there's more risk in a 2% bond than there is in 1,200 gold.
So you agree with the level that gold's currently at, or do you think that there's just big money interested in gold right now and perhaps they think, we could possibly see a really big correction here on the stock market?
That's a really good point. And let me just take the word gold out and put the word stocks in. You'll also start seeing in mainstream media stocks dropped because bond yields are higher and bonds are competing with stocks. It's all going to go the same way, meaning stocks and bonds will both drop. But to answer your question, the way I think you put it is that yes, there could be a large correction in stocks, and once it happens, the media will say it was because bond yields were higher. But I don't think that will be the driver behind it. Correlation and causation are not the same in that situation.
Finally, Vince, I want to get your thoughts on the news coming out of China and its apparent decision to hold back on U.S. Treasury purchases. How big is this news for you? Is it relevant? Is it not? Some have suggested, look, it's just meat to chew on today, but the news will go away. How do you see it? Meat
to chew on. That's a great phrase, whoever said that. In the very micro, apparently people care about it because they're using it as headlines. The Chinese aren't buying bonds. The only asset that cared about that today, was happy about that, was gold. That's true. But if you just go back a couple of years, in 2016, the Chinese were net sellers of Treasuries as well. Gold went up 8%. In 2017, the Chinese were net buyers of Treasuries, and gold was up 10 or 11%. So in the long term, for different reasons, gold will continue to go up as Chinese buying of treasuries deteriorates. But in the micro, it is just meat to chew on. It's just something to talk about. It doesn't. It's an impetus to cover your shorts if you short gold, but you should be buying gold anyway. The Chinese are not. The Chinese will stop buying our bonds because, as American consumers, we can no longer afford their iPhones.
All right, Vince Lanci, always good thoughts. Thank you so much for joining us.
Thanks for having me.
And thank you for watching. We'll be back tomorrow.